Hi, everybody. My name's Brian Griff. I'm our Armanino's Midwest Geo Leader and Manufacturing Industry Leader. We've got a webinar planned today to talk about tariffs and what we know as of right now on this panel. We've got a number of subject matter experts. We're going to be covering things such as how the tariffs impact pricing strategies and your competitive positioning. We're going to cover how to navigate the international tax implications caused by the tariffs. And we're going to also talk about transfer pricing valuation adjustments that could impact the tariffs. But before we get into that, just wanted to share with you, for those of you who are new to Armanino and this first time on this webcast, Armanino is a top 20 firm that are part of more global with international resources in over 300 countries. So we've got a lot of international experience. Got very strong industry teams. I sit on the manufacturing team. A number of people on this team are on either or the technology team. We're gonna address how that could impact all the different industries. But I want to emphasize that we're a top 20 firm with accounting, tax, consulting. Consulting was one of our strengths. All the members on this team have tax and consulting backgrounds, so we're going to get into the panel here shortly. I want to make sure we can have each of them give a brief intro, and then we're going to get into a lot of the details here. We won't be able to cover every question. We have got a number of questions from the attendees in advance that we're going to try to weave into our presentation, but we will follow up with details after this, and we plan on having an ongoing webinar series since the tariff changes are happening every day. So I'm going to turn it over to Amy to give a brief intro, and then we'll go around the horn, and then we'll get back to the presentation.
All right, thanks for having us on today. I'm Amy Julian. I'm a partner on our strategy and transformation team.
Good morning or afternoon, everybody. I'm Jason Woon. I'm a partner in our valuation and financial modeling team. And today I'll be talking about how tariffs affect operations, financial planning, M&A, and valuations.
Good morning, everyone. Kenneth Corwanto here. I'm an international tax partner with the firm. Our team deals primarily with tax planning and structuring for both U.S. companies with foreign operations and foreign companies with U.S. operations. So tariffs obviously is a big factor into our tax planning these days. Looking forward to sharing more thoughts about tariffs.
Good morning, everyone. My name is Nhi Nguyen. I lead our transfer pricing practice here. It has certainly been a key factor with a lot of our companies and with their related party transactions and how our clients are, impact how the tariffs are impacting their planning and their modeling scenarios.
All right. Thanks, team. Again, I'm Brian. I'll be hosting and moderating this webinar. Prior to an hour ago, our economic strategist called in sick. He had done all the research on the tariffs that he was going to present, and he was actually going to moderate the panel. So I'm jumping in to do the moderation real quickly. I mean, there's 30-some pages here on all the changes in the tariffs today. I don't want to get into too many details because it is changing every day. By the time we finish this webinar, some key findings could be coming out. But what we know is, the 10% baseline tariff has been put across the board. We know the China situation is evolving as we speak, much higher tariff rates, anywhere from 135 to 145%. But even this morning, they came out and announced that they're going to exempt some products. So, I mean, it's changing. The key is going to be with all these countries engaged in negotiating this. I mean, as of right now, if things were to be in place that has been projected, the tariffs could raise potentially $2.1 trillion over the next 10 years, but it could have a GDP impact of up to 0.8 to 1% and a negative impact on household income. If you take that into account with all the other things that we've heard about, deregulation across all the industries, the dollar valuation, the currency impact that it could have, the price of oil, then the tax laws, the interest rate environment, all these things play a big factor. And we're going to try to get into how we can help our clients, be proactive and do things. I've attended a number of seminars in the last and conferences in the last couple of weeks, and there's a lot of advisors just telling their clients to wait and see. We don't believe that's a good approach. We think we can be proactive. We think there's things that our clients can be doing to take advantage of the situation, take advantage of their competitors who are sitting there and waiting to see what happens. We want to take a much more proactive approach to this. So let's get right into it. I mentioned earlier I lead the manufacturing industry, but I'm going to this to the panel who participate on other industries. Is this just a manufacturing thing? President Trump talks about doing a lot of this to bring manufacturing back to the States. Is it just a manufacturing issue, Amy?
Definitely not just a manufacturing issue. We see it across lots of different industries. For example, we've been talking to our healthcare industry leads. Right now, there's no exemptions for medical devices, so that is impacting healthcare kind of along their supply chain. Pharma itself is still exempt, but some of the active ingredients are not. So a lot of different health chains and providers are still trying to figure out what to do, how that exactly is going to impact their operations. And that's in addition to some other things that are impacting them too. So we're seeing it. That's one industry example. Jason, I know you're in the tech industry team. What are you seeing there?
Yeah, even the technology industry where I play a lot in is affected, and not all companies within the industry equally, right? So semiconductors, high-tech manufacturing could have direct component impacts in their supply chain, but even services companies could, like as Brian mentioned, have reduced consumer demand here, which will have the trickle-down effect. And I think we're framing the tariffs as direct impacts and indirect impacts of tariffs. So I think and maybe even trickle-down effects even. So I think those are key things to kind of think about. And I guess I'll just add that some tariffs are even beneficial to our clients. We have a client that does US mining rare earth materials, and they're happening to be a public company, and their stock price has increased 25% since Liberation Day. And another company does US manufacturing solar panel equipment, and they've received a lot of inbound interest. So tariffs are not just a broad-based thing that we should pay attention to.
Yeah, great. And as I mentioned, we've got such a great panel here. All of these panelists produce thought leadership all the time in their areas of expertise, but every one of them work with their clients on a day-to-day basis. So can all of you go around the horn and let's share about how are you seeing impacting your clients that you're working with today? We'll go ahead and start with Amy again.
Yeah, so a lot of my clients are really revisiting their own strategic plan. They want to understand where do they fit in the industry? Who are their competitors? How might their competitors be impacted? Where their growth plans? How is it going to impact that? So they're really taking that step back and making sure they understand like their core strategy and how they fit in the market. So we're seeing a lot more of that type of thing first. Then, of course, they're going to try to understand the impact of the tariff itself. So lots of questions. And I know that's where Kenneth and me are really getting deeply involved in helping people figure that out. From there, we see them trying to figure out pricing strategies. And I will talk about this as we get deeper too, but you have to figure out exactly how does this impact my margin? And then is there something I can do on the pricing side? So lots of interest and discussion. This is something we see companies should be proactive in building collaboration events around anyway. So I think it's accelerating the maturity in how you think about pricing in your go-to-market. And then, of course, I mean, my background where I'm deepest is supply chain, kind of daily operations. Some of it is like purely operational. Do I have to look at my footprint? Do I have to really think about my source of supply and how that changes? So they're looking at all of those different strategies from the very short term to kind of medium term and long term. And it just runs the board.
Thanks, Amy.
I'm going to chime in here. I'll just say, my lens is from the financial and transaction space. So, we see clients taking different steps to adjust their tariff strategy. One is scenario planning. And I can touch a little bit more into this later, but just having a plan in place is probably the first good step, right? And understanding where you're at. So along with that, there's the short-term, medium-term, and long-term planning. Tariffs, if they have a direct impact, are going to affect your net working capital and liquidity position. So not only inventory and maybe cost of goods sold, but also are your customers going to be paying you as quickly? Or should you be holding onto your payables a little bit longer, things like that. And then some clients are maybe not even addressing tariffs yet, what I've heard, because they're waiting to see. Maybe they've built up a few weeks or a few months of inventory right before this is kind of all happened, if you will, just in preparation. And they may have locked in long-term supply contracts. I talked to one client earlier this week, and they said, "Well, we'll wait and see. We're okay for the next 3 or 4 months here." So it could easily be a wait and see moment. But I don't know, Kenneth, anything to add?
Yeah, sure. So from an international tax perspective, our clients right now are looking to see, basically evaluating how the current tariff rules actually impact their current supply chain, their current business, based on what they're doing without making changes. What's the impact? And as part of that, it's not just simply determining what rates would apply, but also analyzing if there's any tariff exemptions or exclusions that are available for our clients. Whether there's ways to reduce the import value, whether there's ways to rely on trade agreements to actually get the goods completely out of the realm of tariffs. So those are things our clients are looking at. And based on that analysis, they've been mapping out different alternatives, ways that they can achieve a better tariff answer without disrupting their supply chain in a substantial manner. So that's what they're currently doing. But I would say it's currently at the evaluating or mapping out alternatives without actually making the big investments or changes yet.
Yeah,
And Lee, do you want to comment more from a transfer pricing perspective?
sure. And I'll chime in from related party transactions. A lot of our clients are multinationals that have operations with related parties. And so they're trying to determine, potentially how to share the tariffs between related parties, reviewing whether the tariffs should be shared between the manufacturer with the burden by the manufacturer, the distributor, or even the parent company. Should the importer bear the full burden of the tariffs, or should it only bear a portion of it? Should a portion of it ultimately get passed on to the consumer? So there's a lot of discussions with clients on which entity within the related parties should bear that tariff cost at all. Also, we do see clients are adjusting their transfer pricing methodologies to reflect that increased cost, but at the same time, how do they ensure their results are still arm's length in light of tariffs? Other clients are also considering seeking approvals, advanced rulings from the customs authorities to confirm whether their treatment of related party pricing adjustments, like after you import the cost of goods sold from a certain price, and if you're making related party adjustments, will the customs authorities, approve of that? Additionally, where our clients have intercompany agreements in place, they are also revisiting their clauses in the intercompany agreements to see if they can allow for some of the cost to pass through, the tariff cost to pass through, or make tariff related adjustments, to their financials and include that in their intercompany agreement as support to memorialize these type of changes. Clients are considering potentially revisiting their entire transfer pricing structure and, revisiting whether the entities that are, limited risk with limited functions, limited risk should bear more of the risk from these tariffs on the fallout. And so there's a lot of modeling that I had mentioned that is taking place by our clients to really assess what is that outcome, what's the tax implications if you do change the transfer pricing policy, internally.
There's a lot to digest there. Kind of leads into an attendee or a participant question that we got from one of the attendees in the audience that I want to bring in here. Amy talked about different types of scenario planning. You were talking about certain exemptions, Nia. All the things that you were talking about. I've heard a term called tariff hopping, as companies are trying to look at, where are they sourcing the goods and can they source it through different countries to maybe avoid some of the tariff hopping. There's so much involved here. And one of the questions came back is, what scenarios do you recommend a company go through as an organization? And should they only be thinking short-term or long-term in nature, given how this is changing so often? And I kind of turn to you, Kenneth, because you're talking about the exemptions and the impacts on transfer pricing. What are your thoughts there?
Sure. So the reality is, and this is just my opinion, tariffs are likely going to be around for the next 3.5 to 4 years, basically. At the end of the day, it's just a matter of what rates would apply to certain countries, depending on how the negotiations go within the next 90 days. If there's any exclusions, rate changes, or product-specific type of exclusions as well. So from the way we look at it is organizations should really evaluate these different scenarios on the assumption that tariffs will still be around, again, making immediate changes, basically. So I'd say plan for the short term in terms of, because we don't know what's going to happen really within the next 90 days. But at the same time, in a longer term, for the next 3 to 4 years, plan out your scenarios as if tariffs were still going to be around, depending on which countries you're purchasing goods from, although it'll likely be something that's prevalent across all different countries. And then, Jason, do you want to add to that?
Yeah, kind of along what I was saying earlier, agree with you, multiple scenarios, and then different time frames for potential actions here. So the immediate short-term needs to look at and pricing and inventory management. So again, extending receivable cycles, lengthening the turnover ratios, contribution margins, things like that. In the medium term, then, and I should say in the short term, you can look at a base case, a pessimistic case, and I'll call it optimistic case, if you will. And that could be the effects of, hey, are tariffs going to be lifted and at what period? Or are they going to just be in place and we're going to have different demand or cost structures here? So as you can imagine, if you've got a tree that's kind of blowing out, this could be quite a modeling exercise. But then taking a step back and not just in kind of the day-to-day trenches, the medium term is looking at, are there new sourcing alternatives? And can you develop new products or services to address the tariffs? I mean, if there's going to be reduced demand in one thing, is there an opportunity in another? And then the harder part is the long-term structural changes, cost of capital, opening up a new factory, things like that, more corporate finance, if you will. And I guess the last thing I would say is that there's a lot of work, and while organizations can do this themselves, they have to run the business. And so, which is why we're all here to kind of help with that.
I'd probably like to just add a few points just, from a transfer pricing perspective, international trade contents, and to the extent you have related parties, one of the short-term solution or, that you can take on is to just look at your cost of goods sold, because generally to make adjustments to their cost of goods sold to align their transfer pricing with the arm's length principle. And under the current environment, you need to review the adjustments to ensure that, for example, the COGS excludes, management, other service fees, royalties to the extent possible, or logistics costs when, when companies are analyzing their intercompany pricing. So under the current environment, you definitely want to really dissect all that. What's the buildup of the cost of goods sold? Prior to this being, slapped on by the, Trump administration, no one really probably bothered to look into that makeup of the cost of goods sold, but that's definitely a different story in this current environment.
Thanks, Nia. I'm going to follow up with that in a second, but Kenneth had mentioned exemptions. I think I said earlier, China came out and listed some exemptions today. Kenneth, are there any other exemptions that the audience would want to know about?
Yeah, sure. So in addition to the product specific trade agreement specific exemptions, some things to look at, for example, if you've got materials or products coming into the US and there is a good chance that the products have 20% or more US content material, there is a chance for you to be able to import the products and basically break out what the value is between US versus non-US content and only be subject to tariffs on the non-US content of it. So for example, if the product is $100 and then $40 of that comes from US content materials, then potentially only the 60 is subject to tariffs. So that's one way. The other, it's not so much an exemption or exclusion, but just a rule to apply, is what's called the first sale rule. Basically, if you're purchasing a product from a third party, from let's say a supplier, but then the manufacturing was done in a different country, if the first sale actually is at a lower import value or has a lower value and it's transacted at an arm's length basis, you could, instead of importing the product at the last sale that you purchase it, the import value is actually the first sale from the manufacturer to the supplier or the middleman, if you will. So it's obviously easier if it's a related party transaction, but there's more complexity if it's unrelated parties in that how much information are they willing to divulge and all that stuff.
Thanks, Kenneth.
And Kenneth, maybe just one more kind of question, because I've seen it come up from some of our clients too. So exploring free trade zones, and kind of, is that an option or not? I mean, I think I've seen some recent news that there might be changes coming to what that looks like, but our understanding is it's an option, but it might not actually be the best fit as people initially think. Anything you can comment there, Kenneth?
Yeah, I would say free trade zones are still a thing. I mean, they're still available and can be used by companies. But the reality with free trade zones is it basically defers the payment of tariffs when you're importing the products to the US, and then there's some US processing or manufacturing that happens, and then the products get shipped back out from the US, let's say to Canada and Mexico. So it does, there is some application there, but the reality is US generally has not for the past several years been a center or manufacturing hub. So usually when there's US manufacturing, it's usually for US consumption or use, but it's not common that you'd have products, for example, imported from China, processed in the US, and then sold back to Europe.
Kath. And so Mia was talking about the intercompany pricing and tariff impacts on transfer pricing. And then, Amy's group looks at pricing and margins. As a former CFO of manufacturing and retail companies before coming back to public accounting, I was always responsible for, analyzing the margins, were we selling the right products, all the impact that it has on the bottom line and EBITDA. I've seen firsthand with Amy's group how good a job they can help companies identify specific product issues, margin and opportunities to improve. Amy, you want to talk a little bit about this changing landscape and what companies need to be thinking about to stay ahead of this with their pricing for their customers?
Yeah, what we see firms who really manage pricing proactively, so they've already built kind of that core capability, is really having a point of view by channel, by customer, by SKU of what that should look like. And that's going to be both pricing, promotions, how do you kind of discount that element of that. But you need to have that kind of trend to make sure you really understand all of the elements before that. Sometimes when we work with customers who have done pricing, we'll run just our basic analysis, and you can see there's no true strategy behind that. So they don't really know, what channels can bear what type of price increases, how do we need to discount or promote. And then getting ahead of the market too, something I've heard a lot of from different customers, like right now, right? Like they aren't sure as they start to take pricing increases, or if they do have to make pricing changes, how that's going to impact demand. So that's where we've been partnering with Jason and his team too, to say, what is that sensitivity? What do we think that looks like? And then you can actually go out now and get market data in some pretty effective ways through different modeling and AI techniques to say, hey, what do we think that expected impact is going to be, and allow you to make the right pricing decisions. So we're seeing a lot of that capability really accelerating because of the current tariff landscape.
I would just add maybe, look at your competitors if you're in a competitive environment. What are they doing? I know, Amy, we've had some discussions on, do you impose a tariff tax, if you will, or surcharge versus just increasing prices? And, at least one client we talked to said that if we raise prices, then there's probably no going back, versus if we have a surcharge or a tax, then, our customers may ask for us to reduce that in the future or eliminate that in the future. So, depending on your sensitivity for consumer or customer demand, as well as your competitors, I'd say. And then there are also, you could look towards precedent in 2018, 2020, when there was a initial round of, tariffs on China, for example, if you're impacted by Chinese goods. So I look at demand sensitivity there and pricing in your organization.
Yeah, as an example, we had one discussion, and they knew kind of their competitive market really well. They had enough cash to be able to buy forward on inventory, and they were planning to do that to be able to keep their prices down for a period of time and hopefully get into accounts that they hadn't had access to before. So it was a really very strategic, kind of well thought out plan as they decided how to react appropriately. That all said, I know there's a question like, will tariffs really impact price? The expectation right now is that it will. We just don't know exactly by how much.
Yeah, I can remember during President Trump's first term being brought in by a PE firm that their portfolio company was insisting that they were passing on all the increases through to their customers. And the bank stepped in actually and said, the cash flow is not there. We want, an independent firm to come in here and analyze it. And sure enough, we found that there were things that were escaping. There were 6-month contracts that price increases couldn't be put into effect until after the 6-month period. So it's a very complex issue. And now it's even, it's on steroids with all the different countries that are impacted by this. So want to move on to another subject here as far as working capital. What are you guys seeing as far as inventory management? Are you seeing pre-buying? How are you advising your clients? I'm going to turn over to Jason because I know he deals with that a lot on the opening balance sheet valuation side.
Yeah, a lot of trade-offs. And I think it highlights the need to really get in the nitty-gritty, collaborating with the finance and operations team here, because it really is being sort of in the trenches, if you will, is what I would say. So, I mean, creating the pricing flexibility without kind of taking up too much capital, it is that balance and trying to fine-tune your liquidity position to be in an opportunistic, spot. So if you've already built up your inventory in advance, you're probably okay for a little bit, but then always planning ahead, because none of us know how long and the effects of, I'll say, direct and indirect effects of tariffs even, really. And then I would just highlight again, what are your competitors doing here? Because if there is going to be a supply chain or shortage here, you don't want to be on the other end of that stick as well.
And Nee, does this have an impact on related parties and their pricing?
Yeah, so when it comes to related party transactions, companies consider like periodic repricing of, the cost of goods sold either on quarterly and monthly basis, just to, essentially factor in the changing landscape of the tariffs and how it's going to impact the overall financials. I mean, looking at it from a monthly or quarterly basis rather than just at the year end would be very worthwhile. I mean, companies can, I think we've mentioned it before, but companies can consider building up inventories in advance of anticipated tariffs. But we also see companies holding off on buying inventory, with this anticipation that the tariff rates actually will go down after the negotiations between the Trump administration and various countries. We already heard that there's constituents from Korea and Japan at the White House this week. Also, companies can also consider, the country of origin rules, maybe shifting production locations or sourcing goods from certain countries, or avoiding excess inventories just so that they don't have to deal with the write-down impact of the tariffs. That's what some of our clients are considering, those types of options right now.
And we have clients as well who they're taking advantage of CED exemptions, for example, like the 20% US content material or the first sale rule. Instead of basically bringing a huge batch and seeing what customs would do, they would bring in small batches just to see, okay, we apply this new HTS code classification and adopt a lower import value based on the rules. How would the CBP react towards that? So that's what's happening as well to some of our clients.
Yeah. And I want to follow up. Are there any international guidelines that could be impacted by changing pricing structure and strategies?
So for under the transfer pricing landscape, people are operating under either the US 482 transfer pricing regulations or the OECD transfer pricing guidelines. And similar back to the days of COVID and all the impact and disruption to the supply chain, to the economy, when everything, stalled for a good 2-3 months. That definitely disrupted the financials, and it had a significant impact to all the companies, and it also disrupted the transfer pricing policies for a lot of the companies. So similar to what happened back then, companies have to then now revisit their intercompany agreements, make sure that it's updated to meet the market conditions, or add language to in your intercompany agreements to allow for some flexibility in case the entities don't achieve the targeted profits that they're supposed to achieve pre-tariff. So I think you have to allow for that flexibility in that agreements. Additionally, companies, when they're doing their analysis and benchmarking their profits and what they should be earning against other third parties, it's with the whole tariff situation, it's going to lead to a systematic increase in costs to all the benchmark companies, and that's going to impact the profitability levels that the related parties should target. So you definitely need to revisit that. Also, should also consider adjusting the pricing of transactions to be at arm's length, but more favorable in order to manage tariffs. So as I mentioned earlier on, companies have to determine which entity in the whole tax structure should be bearing the cost of the tariffs, because you have one entity that, let's say the importer is bearing the cost, entirely bearing the cost of the tariffs. The importer, could be in a negative, could result in negative profits, while the manufacturer has, their profits are left untouched and continues to report very reasonable profits. I mean, I'm not sure that's going to make sense from a tax perspective for all the companies. So companies need to, model that scenario and weigh in the pros and cons of which entity should be bearing the tariff cost.
Thanks, Nate. And Amy, you're a supply chain specialist. What's the impact on there, and what are things companies should be in their suppliers or reviewing with their suppliers?
Yeah, so I've gotten the question before, like, hey, can't we just negotiate with the suppliers for this? And of course, the answer is going to be yes, right? But just like any US-based company is going to be facing margin pressure, so is that supply base. So really kind of understanding what are the implications to them, how do we kind of either share that burden if we think that's the right thing to do, or if they are able and willing to do that, can absolutely be a part of the conversation. So similar to kind of the transfer pricing discussion, know the supplier, know the category strategy behind that supplier base. Is this a large commodity where it's easy to find another supplier in another country? That's all going to give you some information about what your negotiation leverage is going to be in working with that supplier. What we see kind of more broadly is it's hard to change supply chains, right? So depending on what you're producing, you might have quality things that you have to go through before you can even qualify a new supplier. So it's going to depend on that piece of it. There may be offsetting costs, to get it from a different market in terms of transportation that don't make sense. So you really start needing to have to weigh all of those things. For some of our as well, they're even looking at that footprint analysis, right? To say like, hey, could I do something different with my operational or vertical and say, could I produce more of something that's more heavily impacted by tariffs in one of my own facilities and to change that overall structure? That's not a fast or immediate strategy. So they're really trying to figure out what is the speed that I can actually do that. And does that make sense given the uncertainty in the environment? I mean, things were already happening even prior to some of the tariffs to bring back some types of manufacturing to the US. But what had done in some industries is you have a concentration of things in the US, but their supply chains may have moved to nearshore for the more labor intensive. That was oftentimes going to Mexico, or higher tech, which is oftentimes going to Canada. And then the final kind of pieces of that might be happening in the US. So with some of the news prior to the pause, that kind of ended some of the economics of it. But if you do that detailed analysis of what does it actually cost to make this within my supply chain, it still may not make sense. So again, kind of back to scenario planning, what is that outcome? So really key things from a supply chain perspective, understanding your supply base and the category strategy related to what you're purchasing, understanding your footprint as well as theirs and kind of what's possible, and then being able to model that in with your overall cost of goods sold and footprint models.
Thanks, Amy. Before I get into a more technical tax question, Kenneth or Nee, anything else to add to that?
I think Amy covered it. Thanks, Amy.
Okay. So I saw a question from the audience, but we also had a question here about, how should multinational corporations adjust their tax structures and strategy based on this? And I think another question came up is, could this impact the corporate tax provisions for a company? So Kenneth, can you try to address kind of the overall tax strategy behind what companies should be doing?
Sure. So we're looking at a global company that has various foreign subsidiaries, manufacturing subsidiary in, let's say, Vietnam, Thailand, or China. There's always a question about, can we structure our related party transactions? Can we structure our transaction flows in a way whereby any imports coming into the US would basically have a lower value, basically? And we need to do that holistically, meaning we can't just look at reducing the import value, but we also have to see if there's any kind of different types of payments that need to be made from the US to the foreign subsidiary that don't attract any kind of import value for that's subject to. And then that's one thing to look at. But the other part that's tricky is if our clients in the US are importing from third parties. If you've got third-party contract manufacturers or third-party suppliers, that's where it gets a little bit tricky because there's things that you can do as opposed to if you have a subsidiary that does the manufacturing for you. It gets a little tricky, but obviously it really depends on your relationship with your suppliers. You could talk about how you could structure a contract differently or more creatively to fit your needs to basically reduce that import value. So those are things our clients are looking at. So I'd say more from an international tax perspective, it's just trying to see how we could kind of reduce that import value at the end of the day. But then at the same time, I'm staying abreast of the international tax rules and also keeping in mind transfer pricing as well to ensure that both tax authorities are happy that are involved, so the US and the foreign country.
So definitely from the audience question about could it impact corporate tax provision planning? Sounds like all those things need to be taken into account.
Yeah, one thing that is being talked about, for example, is kind of an indirect impact, or it's basically in line with the Trump administration wanting to bring more manufacturing jobs back to the US, is that there's talks right now about basically reducing the corporate tax rate for US manufacturers to actually 15%. It's currently at 21%. So that's one thing that could be affected basically is that they're basically giving more incentives for companies to actually bring their manufacturing, their production back to the US. So in compensation for the potential tariffs that they could be hit on if they have to keep their manufacturing overseas.
And kind of related to that, do companies need advanced pricing agreements and mutual pricing agreement procedures with foreign countries or just related to the related parties?
Yeah, so let me give a little background on what pricing agreements are. Advanced pricing agreements are agreements with authorities. They could either be a unilateral agreement, just an agreement between one jurisdiction, or a bilateral agreement, an agreement between both jurisdictions. And we do see that in light of the tariff situation and potential, clients getting whipsawed with taxes as a result of the tariffs, that there would be an increased need for companies to consider an advanced pricing agreement. Advanced pricing agreement provides an opportunity for clients to get certainty in a very extremely uncertain time. So if there is any certainty to be gained, and this is the route that clients may want to pursue, because then with an advanced pricing agreement, you could present your situation to the taxing authorities. You could present your proposed approach on how you plan on dealing with the tariffs. You can say, I'm going to have company A, earn this targeted operating margin. Company B will earn this targeted margin, and this is how we are going to deal with the tariffs. How we're either going to shift the tariff cost to this entity or the other entity, or share it with the end customer. But here's our proposed results. What would you agree? Now, given the tariff situation, a unilateral agreement, which is just an agreement with one may not be beneficial, right? Obviously, tariffs is going to impact, the other side of the equation as well. So perhaps I think a bilateral APA agreement would be beneficial, been more beneficial to companies. Now, we've seen this actually be really successful because, during the COVID days, there was a lot of economic challenges that companies had to deal with and other upheaval. So companies definitely reached out to the taxing authorities and pursue these advanced pricing agreements to, be able to effectively respond to that situation. And in light of this current situation, we're dealing with tariffs, because inevitably, how taxing authorities are going to respond, they're going to respond on a case by case basis, right? If the US importer has to bear higher cost of goods sold from an Asian manufacturer, do you think that Asian country tax authority doesn't care? It's not their problem. It's the IRS problem. So there's going to be, under this current situation, you're going to inevitably see some increased tax risk. Companies are going to get, double tax in situation, and it's hard to avoid that. And so as a result, we are going to see an increased need to reach out to our competent authorities, or that, which is our MAP program. And so under the MAP program, clients could avoid a situation where, they're dealing with double taxation.
Kenneth and Nee, you guys have done a great job answering tax questions. As a former CFO, those were usually afterthoughts sometimes to me. So I want to spend a little time with Jason. Jason spends a lot of time with his clients talking about their balance sheet, their valuations. What kind of impacts could this have on impairment of assets? I know revenue recognition might be impacted. Jason, can you talk about how you're advising clients about just general accounting procedures that these tariffs could impact?
Yeah, broad-based impacts to cost accounting and financial reporting. Kind of like what Nee was saying, I think I kind of go back to the COVID-19 days in March 20 and April 2020, and then also the aftermath of the stock market rebound and supply chain upending. So I guess to start, yeah, Brian, you touched on impairment. As the tariffs have a direct impact on supply chains, we could see impairment across long-lived assets, i.e. fixed assets. So if you have a plant or equipment in another country and you're no longer going to be producing as many goods because it costs more to import, there could be certainly an impairment trigger on those assets here. Similarly, if you've made acquisitions overseas, there could be impairment on goodwill or other intangible assets, possibly, some brand diminution as well. So I think impairment is probably the first thing. And then, that's a triggering event exercise. And so I think some companies are in the wait and see moment. I know there's a question about how many are being proactive versus wait and see. And I think impairment is probably a wait and see for this quarter, to be honest. Alternatively, inventory could be impacted, just having to measure lower of cost or market. So if inventory values have, kind of fallen just because demand has fallen and whatnot, might have to take a write down there. If you're locked into long-term contracts from a revenue recognition perspective, those also could take a haircut, if you will. So I think it's important to kind of look back at ASC 606 and kind of evaluate those contracts as well. And then Nee was talking about all the tax logistics of pricing and supply chain, but there's also the financial reporting and the systems. Is your GL or is your reporting packages, are they set up to do all these changes, and the operational accounting, if you will, to kind of dig into those. So, there's a tail, just like the tariffs, there's going to be a tail to the office of the CAO and the controllership.
Thanks, Chase. I know you also deal with clients who are going through financing or are considering transactions. You get involved a lot with helping with forecasting and projection. What are some of the indirect impacts? We talked a lot specifically about direct things that we know today, but what are the indirect impact of the uncertainty going on with these tariffs?
Yeah, so kind of touched a little bit about this earlier. So I think just general economic headwinds, as we can see, consumer confidence as at a very low, relatively low point here. I think the latest reading was in March, and that was before Liberation Day. So that will be those spillover effects. We've seen borrowing rates measured by kind of the 10-year US Treasury still quite volatile, honestly, but still somewhat elevated, and the US dollar depreciating. So again, that could have, for a multinational company, that could have quite a big impact as you're repatriating dollars back to the US here. And then if just kind of naturally tariffs tend to be inflationary, and so even your employees will feel the effects. And if it costs more to buy some blueberries and peaches at the grocery store, then they might want demand higher wages, as we saw during the days of COVID, if you will. The other things that we're seeing here are impacts on valuations, of course, and that's an area that near and dear to my heart. So cost of capital, not only debt, but also equity risk premiums, so demand for equities that are increasing there. Along the same lines, as we're talking about scenario planning, there's forecasts that may need to be revised downwards, and that's obviously a direct impact on companies' valuations here. Volatility in the market has spiked, and that triggers things like increased illiquidity in the market. And so that could increase discounts, I should say. We've talked to different bankers, and the IPO market is, kind of on pause at the moment here. And, most of our clients are, or many of the on the line here, are maybe not going through an IPO, of course, but there's a trickle down effect in the market. It's all about liquidity and capital market readiness here. So I know a couple of companies have paused their IPO plans as of late. Thing on the M&A side, I will say that maybe at the lower middle market, M&A still seems to be somewhat active, just because their companies of a smaller size tend to be a little bit less affected, if you will, by some of the tariffs, at least in the short term. And then the other interesting thing is, trying to be positive here, is if you're a business owner, and it might be a good time to start doing some gifting or estate planning, because if asset values are actually lower, it might not be a bad idea to do some gifting for in preparation of future events. So lots of effects, Brian.
And I know all of you get involved sometimes helping our clients with transactions, and the M&A market has been fairly slow for the last couple of years. But is there anyone want to speak to if a company is in the process of acquiring a company? I mean, all the risks and uncertainties that you guys have all talked to, I guess, need to be taken into account. How have you been involved in helping a client with being proactive and moving forward with that, or is it kind of a wait and see standpoint? Jason, I think you've probably been the most involved in that.
Yeah, I think quantification of the impact of tariffs from, a buyer might want to see that, or if you're selling your company, of course, can you quantify that? Because a buyer will ask exactly that. And so having those different scenarios for in an M&A transaction and modeling that out, and if you're on the buy side, having those available for your leadership team, I think is one way to kind of get out in front of it. And then it's just, what is your personal belief on that? And I guess I'll just add that, there could be strategic acquisitions that make a lot of sense. If companies want to upend and amend their supply chain, or want to increase technological capabilities, or whatnot, then there could be a strategic reason to still do M&A for sure.
Yeah, and Amy, I know you get very involved helping companies with exit planning and preparing to sell their companies with operational improvements and assessing the risks of a company going through a sale process. What are you advising clients to do that still want to go through, selling their company?
Yeah, I mean, I think there is, Jason was mentioning, there is upside, especially if you are a US-based company, right? We're seeing like that may actually be seen as an advantage as companies seek to expand. So I'd say, figure out where you stand. Are you US-based? Is there strategic acquisition that really might make sense for you, where it didn't make as much sense a couple of years ago? So that's an opportunity we're definitely seeing people start to lean into. If it's a more standard, not specific advantageous right now, definitely have that story ready about like, what are the potential impacts? Where are your exposure points within your supply chain? So I think people will start asking for that, and they already have. And not everybody was really prepared for that within their prep materials or the due diligence aspect of that. So they'll want to know, they'll want to see some level of modeling. Hey, if this impacts your costs, what are you going to do for price? They'll want to see that you've thought it out and have kind of a strategy behind that. So we're helping people kind of think through what to do, how to present that in a way that makes sense to potential investor.
Yeah, on the line of modeling, I mean, typically when we do have these uncertain headwinds that are dealt with by companies from a transfer pricing perspective, and I think this would also apply to what Jason was also saying, we take into account like the impact, let's say, of tariffs on the financials. If you took that impact out, what would that for the company look like? Maybe you could do some scenario modeling to show, here's the base case pre-tariff, here's how it impact tariff, but also modeling out for, in the next 3 to 5 years, what do we anticipate that potential tariff rate to look like? And then, model out what it would be looking for 3 to 5 years, and it's probably going to be knock on wood, I would guess, lower than it is, currently. So I think there's different modeling scenarios that companies can undertake, either, whether it's for a sale transaction or just pure tax planning. I think these are all factors to consider, because you want to be able to present to your executives like, here's what we're looking, here's what the forecast is looking without tariffs. with, reduced tariff rate or, hopefully not, even higher tariff rate. So you want to be able to show and pull out that impact as well.
And related to M&A real quick for inbound, we are seeing some level of interest for foreign companies that are trying to acquire US companies with some level of manufacturing capacity. Obviously, if the US is still an important market for these foreign companies, and then they still want to build some level of manufacturing capability in the US without spending the next 2-3 years before it becomes operational, we are seeing a good level of interest in some US manufacturing companies, especially ones that can vertically or horizontally align with the foreign company's objectives as well.
Okay.
Right. Brian,
Go
I
ahead,
was just going to
Jason.
add, there was a question in the chat that I wanted to directly address about quantifying the impact of tariffs, because I think I was kind of mentioning that. And it's difficult, right? I think building a model that you can have different levers in the model and change on the fly as things do change. For example, rates or countries, reciprocal as well, is kind of the only way to do this on the fly. There's always a range as well that you want to have on inputs.
Actions too, right? Like if they hit a
Absolutely.
trigger point, right? Like if they go above a certain percentage point where things do have to change, just having an action plan in place because you don't know, that's really the best that we can do.
That's right.
Okay, I know we're running short on time here. I think we've done a pretty good job addressing a number of questions that came up before the seminar and even during the seminar. We grabbed a couple of those. We will be following up with more details. All of these panelists are on our tariff response team. I'll remind you of that when we close, but I wanted to give everyone kind of a quick minute to go around the horn and kind of talk about, with all this said, what are the things that's most important that you're advising your clients on strategy and trying to be proactive going forward, waiting and seeing and being reactive. So kicked it off with Amy. I'll start with you again to kind of close your section out, and then we'll go around the horn.
Yeah, I think again, the most successful clients that we've seen are really being very proactive on this, that they are kind of building out those models, those plans, so that they can address a range of possibilities and they can act on it very quickly as soon as that information comes in the door. We also see clients being very proactive just in terms of what is coming across in customs. We mentioned that, being very aware of what is happening when it's happening and having a pulse on that. And if you need somebody to take a look at what that customs receipt looks like, that is always a good strategy, especially as we're stabilizing that.
It sounds like we're kind of drinking from the same well, which is I was going to say, get out in front of things and have kind of the right leaders or business unit personnel at the table to start thinking about tariffs, again, direct and indirect effects. I think think of the indirect and the spillover effects in the future, will at least be better prepared. I think there's a lot of data to dig into as well, a lot of information to ask, including from your own customers and suppliers, to help kind of create those informed models. So the better data you can get to help put different assumptions and be ready, right? Because things will change. Last thing I will say is that tariffs are what we're talking about today, but there will likely be other things in the future, like broader tax reform, to model in and out of your business. So getting out in front of everything.
Yeah, some strategies that are, I think, working for our clients is to really ask, just kind of ignoring tariffs basically, or ignoring what's going to happen with tariffs the next 60 to 90 days. Are there specific changes that can be made to your business that you would be making anyway? So for example, we've got clients who they've got manufacturing in a foreign country, and then their quality control is still done here in the US because all the kind of brains behind the quality control are sitting here. Does it make sense for your non-US markets for the products that are going to be shipped outside of the US anyway? With respect to those, does it make sense to have a quality control function in a foreign country in the manufacturing location if it's, again, easy enough to do and it's not cost prohibitive to do as well? And another thing that companies have also been doing is when you're talking with contract manufacturers, so sometimes you have a contract manufacturer in China. Oftentimes those contract manufacturers could also have locations in different countries, Vietnam, Thailand, and all these different places. Is it easy enough for them to basically shift over the production of your goods to those foreign countries, or what the timeline looks like for that? And that way, if the China tariffs remain high, but then the Vietnam or Thailand tariffs stay at the baseline rate of 10%, then at that point, you already know your options and you can easily pivot depending on what happens in the next 2 to 3 months.
Yeah. From a transfer pricing perspective, a lot of our clients are already revisiting what's embedded in their cost of goods sold as they're transacting with the related parties to make sure, to the extent they are facing tariffs on their imported cost of goods, that the cost of goods is, the tariffs is only being applied to that certain material, that component, and it's not unnecessarily being applied to like services costs, logistics costs, or any management fees, procurement costs. We want to make sure, it's the bare bones, the cost of goods sold that the tariffs is really getting applied to. And also, what I've seen clients also do is really modeling out on a monthly, quarterly basis and making adjustments to the transfer price, because you definitely, in light of the situation, there could be huge swings in the amount that your related party cost of goods sold. We don't want to have those huge swings at the year end and see some large year end true up adjustment. You want to deal with it upfront, monthly, quarterly at the latest, so that you are reflecting your adjustments, and then you are analyzing as a company what kind of either additional payment that you may need to make from the parent company to one of your foreign entities, because that foreign entity is being negatively impacted from a financial standpoint as a result of tariffs. So our clients are, already dealing with this and facing this, so that it's not a year. You're not dealing with the year, because if you wait till year end, it's probably too late to make any adjustments, because we're talking about imported goods, and you can't make significant swings to your customs value either. So you need to modify and modulate that, ASAP.
Okay. Well, with that, our first tariff webinar from Armanino is going to come to a close. We have a lot of information on our website at www.armanino.com. As you could tell, we covered a lot of material in this 1 hour seminar. It's just the tip of the iceberg. I talked to a business owner today who said, other than those first months of COVID, this is the most complex, toughest business environment I've been in my entire career. The uncertainties, the challenges, how all this is going to play into effect. And I can speak as a former CEO, CFO, I would want these people on my team helping advise me through this, because it's changing every day and it's hard to keep up just to do business, keep your customers and your people happy. So we will be following up with more thought leadership on this as things change. We'll have other webinars scheduled. We hope you can join us. We will answer any questions that come through the chat in follow-up one-on-one with people, but feel free to reach out to us at armanino.com. Everybody's email address is their first name dot second name at armanino.com if you want to reach out to a specialist directly, or you can go on site and look for an expert at www.armanino.com. That's a mouthful. So thank you very much. I hope everybody enjoys the rest of their Friday and have a wonderful weekend. And thank you to our esteemed panelists here for all the subject matter expertise that they brought to this discussion. Thank you.
Thank you.
Thank you.